The human instinct is to allocate more to a high-performing product. I've learned that the best way to asset allocate is do the reverse. We will need a corpus of 20 crores. 20 crores in today's money, inflated at 8%, is roughly 50 crores 12, 13 years hence. At the point of retirement, I'll need a corpus of 50 crores to have a post-tax lifestyle of around 50 lakhs a year. We're looking at a 2 to 3 year economic recovery in India. If you ally that with political stability and potentially the global rate cycle trending down from next year onwards, I think it bodes well for the stock market, specifically for large cap companies.
Investing and holding on to high quality companies for the long term with little to no churn is the essence of coffee can investing. In today's episode of Guru Portfolios, we have with us Saurabh Mukherjea, who not only strongly believes in the idea of coffee can investing, but also applies the same investment philosophy in his own PMS schemes. Hi Saurabh, welcome to the latest episode of Guru Portfolios.
Thanks, Yash. Pleasure being on Guru Portfolios.
Saurabh, can you tell us what's your current asset allocation mix like?
So look, it's 90% equities. It's been 90% equities for the last 20 years. And then my wife and I, we keep 10% of our savings in fixed deposits. That's a rainy day fund. It's like a safe harbor. If something untoward happens, we'll fall back upon that to finance our lives. But everything that's barring that 10%, 90% is in stocks, mixture of Indian stocks and global stocks, Western stocks, and then again within the Indian portfolio, mixture of large caps and small caps.
So of this equity portion, can you give us a breakup how it is allocated across different products?
So assume that 100 rupees is my total savings. As I said, 10 rupees of that is FDs. And within equities, the largest allocation, 30 rupees, or rather within our total portfolio of 100 rupees, 30 rupees goes into consistent compounders, our flagship product at Marcellus. That's been the largest allocation in my portfolio for as long as I can remember. Thankfully, in the year ending March 24, CCP had a good run. I think we ended up compounding at 24% net of fees. So that's the largest part of my portfolio. The next 15% is NPS. So again, I've been a long-standing believer in NPS. NPS, as I'm sure all your viewers know, is effectively they put the money in an index fund, tracker fund. Fees are very low. It's tax exempt. I contribute, my employer contributes, and therefore that compounds nicely. I think in the year ending March 24, my NPS portfolio grew by 25, perhaps a little bit more, but just to round it off, it's around 25%. So that's 15% of my portfolio. Then 20% of our allocation is in global compounders. So my wife and I believe that not just high-class Indian companies, but high-class global companies. So firms such as, say, products that we use every day, say Microsoft's products or Amazon services will compound nicely. So global compounders is a Marcellus portfolio, which is based out of Gift City, and it invests in European and American stocks. So that forms 20% of our portfolio. That too had a bumper run. I think net of tax and fees, we made around 30% in global compounders. Then from our days in the UK, we have a pension. So I worked for the first 10 years of my career, I worked in the UK. So my employer had a pension plan, I joined that. That continues to compound nicely. That compounded at close to 20%. In the year ending March 24. And the final piece of my portfolio, I think it's around 15% of my portfolios are small cap offering, Little Champs. Unfortunately, in the year ending March 24, Little Champs made no money, so that had zero returns. But 90% equities, as I said, the biggest equity allocation CCP, followed by our global compounders portfolio. But I remain a big fan of NPS as well. And the smallest allocation is Indian small caps, which unfortunately for me in the year ending March 24, it didn't compound for me, the Little Champs portfolio.
So Saurabh, what was your weighted average returns for your portfolio? So
putting it all together, we came in at around the 20% mark. I think net of fees, but gross of taxes, we came in around the 20% mark for the year ending. I think it's a little higher than what I expected. If I look back at our savings over the last decade or so, Yash, we come in at around, my wife and I are able to compound at around the 15% mark. And we think that's the sort of number we need to grow our wealth at to attain our retirement goals.
And Saurabh, so what's your international exposure of your overall portfolio combining UK pension fund and global compounders?
A third of our total savings is in overseas equities, and I believe that's something I think everybody else who's watching this should seriously consider, because if you look around us, right, most of what we spend, if you're upper middle class Indians, much of what we spend on are actually imported products, right? So for example, we are recording this show on pretty much all the kit here is imported. If you look at our personal lives, even if you say buy an iPhone made in India, the bulk of the components of that will come from abroad. If you take a domestic flight, very little of the cost of a domestic flight is actually something Indian. It's basically the pilot's salary, right? Everything else to do with the flight, the plane, the parts, the crude oil is imported. And similarly, if like many Indians, you send your kids abroad to study, that's imported, that's dollar spending. And if you go abroad on holidays, that's dollar spending as well. So I reckon for affluent Indians, anywhere between 30 to 50% of their outgoing, the spending is in dollars. And therefore, I think it makes sense for a proportionate amount of your portfolio to be in dollars.
And Saurabh, how are you planning for your own retirement goals? What is the inflation rate you are considering, for example, and what is your target?
So look, if I look at our lifestyle post-tax through our retirement years, I think we'll need around 50 lakhs. 50 lakhs in today's money. Now, hopefully, retirement is 10, 15 years away for my wife and myself. But if you retire at age 60 and survive till age 85, and we need 50 lakhs post-tax throughout that, basically, we will need a corpus of 20 crores. 20 crores in today's money, inflated at 8%, is roughly 50 crores 12, 13 years hence. So if I retire 12, 13 years hence, at the point of retirement, I'll need a corpus of 50 crores to have a post-tax lifestyle of around 50 lakhs a year. So that's the number we are aspiring to get to, 50 crores 12, 13 years hence. And hence the compounding that we are targeting. We try to get to post-fees compounding of around 15% a year.
And Saurabh, any other big immediate financial goals that are coming up before retirement?
So look, we've got teenaged kids, and they believe they're not kids anymore. They believe they're sort of on the cusp of becoming grown-ups. So they're going to end up going to university over the next 4 years or so. And while it's like every Indian parent, we hope that they get into good Indian colleges. I think as I'm sure you know, Yash, it's very difficult to get into good Indian colleges. Competition is intense. There are many millions of bright kids trying to get into a handful of good universities in our country. And therefore, my hunch is that we probably have to finance their overseas education. And for that, my wife and I have set aside 4 crores for that. So yes, that's the near-term goal. 4 crores will probably get expended on our children's education abroad. And then once that is done, then all we have to save for is our retirement.
And talking about kids, are they also interested in investing? Have they picked up few tips and trips from you?
I think not so much. My son seems more interested, but he sort of oscillates between his interest in music and his interest in investing. I try to give him a few books to read. He reads a little bit of them, and then I notice that he's moved on to reading something more interesting from his point of view. But in early days, they're just teenagers. Let's see how life pans out for them. If one of them becomes an investor, I'll be very happy, but it's up to them what they do with their lives.
And Saurabh, what about your life insurance cover?
Both my wife and I have term life cover. I think if I join up our policies, we've got probably 5 to 10 crores of term life cover, but we have separate cover for both of us.
And your health cover?
So Marcellus provides group health cover. So Marcellus's group health cover is 10 lakhs. So in a given year, you as an employee can draw down 10 lakhs of health cover. Between yourself, your wife, I think in-laws are also, your parents are also covered.
And Saurabh, of course, we know you are a firm believer in the idea of coffee can investing. What's your big advice for investors right now who are looking to enter markets?
We're all human beings, so we get very swayed by near-term returns, and we tend to asset allocate basis near-term returns. So if you take my example, Global Compounders has made a lot of money for me over the last year, and the temptation will be, let's throw more money into Global Compounders. Itna acha kiya hai. And on the other hand, Little Champs has given me 0 returns in the year ending March 24. So the temptation will be, well, usme to paisa banani hai, paisa aur kahin kar do. What I've learned over the last 10 years is the opposite works better. If something's made you a lot of money, keep that investment, but allocate more to a investment which has underperformed for you, because typically high quality portfolios mean revert. So if high quality portfolios have had a great run in the year ending March 24, then agle saal the returns are probably going to come off a bit. And if a high quality portfolio is done really poorly, 0% little champs, then the odds are pretty high. Then the next year it'll do very well. So the human instinct is to allocate more to a high performing product. I've learned that the best way to asset allocate is do the reverse.
Saurabh, what's your outlook on markets given the general elections are coming up, both on medium term and long term?
I mean, look, if you look at the large benchmark indices in India, they have compounded broadly in line with earnings. So post-COVID, Nifty's compounded around 21-22%, and corporate earnings have been broadly in that ballpark. Given that we seem to be entering a phase where private sector capex is picking up, and private sector capex is picking up after some 15-16 years in India, given that corporate India's balance sheet leverage is at the lowest it's been for 25-30 years, and finally, given that the banking system's balance sheet is in the best shape it's been in a generation, I think we're looking at a 2 to 3 year economic recovery in India. If you ally that with political stability and potentially the global rate cycle trending down from next year onwards, I think it bodes well for the stock market, specifically for large cap companies.
Any sectors that you're particularly bullish on?
See, the sector piece I've never been a big fan of, because within a sector you'll have one or two great companies and a whole bunch of mediocrity. So I've always believed, look for the champion player in the sector with good corporate governance, strong return on capital, and strong moats. So for example, the banking sector looks to be in good shape, right? As I said, balance sheets are in good shape, economic growth is looking healthy, potentially a year hence rates will also be coming off. But within the banking sector, we would prefer to focus on 2 or 3 really well-run banks rather than saying as a sector banks may paisa dal dete.
Right. And Saurabh, how do you de-stress, as a money manager, there are a lot of highs and lows. So how do you de-stress?
It's really difficult. As you get older, you learn that the highs you shouldn't take too seriously and the lows you shouldn't get too depressed. But I guess there's 2 aspects to it. One is de-stressing before coming to work. So I've got a yoga trainer and he makes me do an hour of yoga and then 10-15 minutes of meditation before I come to work. And then in the evening, the best thing I found is not to work, because if you go home and after you open your laptop at 7:30, 8 p.m, then it's very difficult to then sleep properly. So I've found that if I go back home, have dinner, spend time with the family, don't open the laptop, I found that's the best way to de-stress in the evenings.
Thank you so much, Saurabh, for joining us today.
My pleasure. Thank you for inviting me to Guru Portfolios.
Hope you found this conversation insightful, and we'll be back with another episode pretty soon. So stay tuned on Mint.